Welcome to the Wall Street Crossover Show, brought to you by Tip TV in conjunction with our sponsors, Admiral Markets. It gives me great pleasure. It's Monday, 15th of June, to reintroduce Mr. Darren Sinden, market commentator for Admiral Markets. Darren, how the devil are you?
Very well, thank you, Nick.
Obviously, a super busy week this week in terms of data, triple watching, FOMC, Greece, data points, companies reporting. Is there anything that you're particularly... well, I guess it's Greece, isn't it?
Greece and the Fed, really, probably in that order. I don't think we'll see the Fed do anything, but as ever, there'll be plenty of people poring over any comment and statement that's forthcoming after the meeting on Wednesday. Greece, yes, back in the frame again. To be fair, though, I don't really. The situation hasn't changed for the last 3 months, but they're toing and froing. We're getting closer to some payment deadlines, obviously, which cranks up the pressure. June the 30th, I believe, is the deadline with the IMF. But what can I say? We've heard it all before.
Yep.
I only believe the deal's done when it's done. Signed in triplicate and probably kissed by the Pope. I mean, it's got to be that good to believe the deal's done. Against that, we're back to square one.
Understood. OK, well, let's kick off. Let's look at our first slide. The data released over the European session. What's caught your attention in Europe this morning? OK,
well, there are a few interesting data points today. The one that's to my eye, first of all, Swiss producer and import prices, a measure of inflation in the Swiss economy, or in this case, not inflation, deflation, in fact, in the Swiss economy. So it's the figure for May. So year-on-year read down 6%. Versus the prior 5.8. Basically, what we're seeing is continuing deflationary pressure within Switzerland. Central bank is trying to
talk up.
Yeah, exactly. Trying to defend the currency, trying to improve the quality of the economy, but it's a tricky business for them at the moment. In terms of an economy that appears to be doing a bit better, though, the trade balance for the Eurozone for April came out this morning, and we saw a 24.3 billion surplus that's in euros, versus a forecast of 20.3 billion and a prior read of 19.7 billion. The surplus is up from around 14.9 billion just over a year ago in April 2014. It's what you'd expect to see, really, with the euro having spent much of that time weakening, and obviously therefore making exports more attractive to foreign buyers. What we might look for going forward is perhaps the import number to pick up as well, as if QE works and the European economy, internal economy, gets going and starts generating demand again. But that's probably for the future. For the moment, though, I think the powers that be in Frankfurt will be very pleased with those numbers.
Understood. Turning attention to Italy.
All right, so CPI, so the Consumer Price Index figures for May there from Italy, year-on-year figures here up plus 0.1% against a forecast of 0.2% and a prior read of plus 0.1%. So an inflation undershoot in Italy, at least by this measure, just showing that it's still a 2 or 3 speed Europe, and you're not getting a unified pattern across the board there at all. And then, as we've already mentioned, the big fly in the ointment again today, European indices low as the Greek talks fail after 45 minutes. So it sounds like they barely got over the niceties, and then they
pot of tea and then called it a day.
Absolutely. And Athens was down as much as 5% on the back of that.
Understood. OK, let's turn our attention to the FTSE 100 movers.
To be honest, Nick, today only one stock really stood out for me, so we just literally have got that one stock on the board, and that was Easyjet, EZJLN, the ticker, £15.47, down around 2.5%. It's quite simply this, the reason for the fall. Royal Bank of Canada downgraded to underperform from the prior outperform recommendation, so they changed their view completely. They were actually quite bullish of EasyJet, but they've admitted today they were wrong, and now they see not only a summer malaise, as we talked about before, but a hard winter for them. They cut their earnings per share forecast by between 10 and 13%, depending on which year we're looking at, and they cut their price target, perhaps even more tellingly, to £15 from £20.
So it's a big downgrade.
It is, and so they're basically saying, look elsewhere for growth in the airline industry at the moment.
Understood. Let's have a look at M&A rumours and movers this morning.
OK, well, today we're looking at the merger of 2 US house builders. These are not necessarily forgive the pun, household names to European viewers, but Standard Pacific Corp, which is ticker SPF, and Ryland Group, RYL, are going to merge. This is it is a merger rather than a sort of takeover. The deal was worth about $5.2 billion when it goes through. SPF shareholders will control the bulk of the company, 59% of the new group, the other 41% resting with the Ryland shareholders. Both stocks were a bit better in Friday's trade, up 1.2%, SPF and RYL up 1.25%. Just to give viewers an idea of the scale of the businesses, the combined sales of homes in 2014, just over 12,600 homes between the two groups. If the merger goes through, this will now become the 4th largest house builder in the US, and that'll be sort of in 4th place behind D.R. Horton, Lennar Corp and Pulte Group. So could be the catalyst here, I think, for further consolidation in the sector, not so necessarily amongst these big boys here, but in the ones, in the
lower down,
F5 and above. The pinch points, though, in the house building sector in the States are very similar to the ones here. A shortage of skilled labour and mortgage lending that's much harder to come by. So whilst there's possibly room for consolidation in the industry, it's still not out of the woods yet and still sort of bearing the scars from the 2007 and 8 successes. Understood.
Let's turn our attention now to US data points to keep an eye out this morning or this afternoon.
Yeah, as opposed to last week where we had a very thin calendar.
We did have a thin calendar.
We've got a lot going on this week, and we kick off with the New York Fed's Empire State Manufacturing Survey for June. The forecast is for a read of 5.9 versus the prior read of 3.09. So looking for a big jump, but what we've got to bear in mind is it's well down, this figure. This indicator from the September 14 read of 27.54. So whatever it comes in at today, it's still got a lot of ground to make up.
So maybe not a reason to hike up rates.
Probably not, no, unless we get a really large shock, but I'm not expecting that. And then onto the wider economy, rather than just a regional survey, the industrial production figures for May. Again, they won't make it particularly exciting reading. The forecast is for gains of around 0.2% compared to a prior fall of minus 0.3%. The other figure that's released in conjunction with that is what's called capacity utilisation, so how much of the manufacturing capacity, industrial production capacity in the economy is being used. The forecast is for a read of 78.4%. That will be slightly better than April's 78.2%. But again, we just put that into context and point out that this has been declining as an indicator again since October 2014 when we had a reading above 79. So still got a ways to go to get back to where we were 6 to 9 months ago even.
Understood. Okay, so let's have a look at the US pre-market movers and some chart points.
In terms of movers, I've actually flagged 2 stocks that moved sharply on Friday rather than in the pre-market, but stocks that we've touched on before. They're Peabody Energy, BTU US and Arch Coal ACI US. They were down sharply on Friday. Peabody Energy down 8.99% and Arch Coal down 12.25%. Coal stocks are under a massive pressure.
Yeah, it was a very negative piece in the FT about coal stocks at the weekend.
If I tell you that Arch Coal was $70 a share in 2008, and you see they're trading at or closed on Friday at 39 cents, you'll get the idea of how these stocks have performed over time. And the reason that they've touched these new all-time lows simply concerns about the cost of insuring against environmental damage in the US.
Right.
And people think of the US as an economy that's not concerned about the environment. I think these figures would beg to differ and tell you now that that's changing.
Understood. In terms of chart points, these are all the cash markets, aren't they?
They are. Obviously, as far as European equities are concerned, we're easier again. So FTSE 66.98, I put there on the downside. You could easily round that to 6,700 even, of course, and 67.60 is our upside level. The DAX 10,940 is the level to watch on the downside. 11,090, the session high effectively there, will be the upside level to keep an eye on. As far as the US is concerned, 2091 here on the downside now for the S&P, plays 2107 to the upside. And in the Dow, 17,852, plays 17,940. Currencies, not that much change really from last week. Euro dollar, we're looking at 111.84 on the downside, plays 112.47 on the upside. Aussie dollar, US dollar, we've tightened that slightly, 77.05 now on the downside, 77.44 is the upside level. Okay. Dollar yen, the yen has managed to hold its own in the last couple of sessions, so 123.18 now on the downside there, plays 123.80 to the upside. And cable again, showing a bit of resilience against the dollar. So now we're looking at 154.80 on the downside and 155.20 the upside level.
Understood. Okay, Darren Sinden, market commentator, Admiral Markets, thank you for that. That wraps up the Wall Street crossover show. We're back at 1 p.m. tomorrow. Have a good day. Thank you.